Look at this. Salesforce stock CRM is down almost 30% this year and has barely moved in the last 5 years. It looks like a dead money stock, right? But here is the kicker. This is a company that has consistently grown revenue in the mid-teens and their free cash flow per share has exploded by over 30% annually for years. Something here just doesn't add up. When you see a great company trading at a price that doesn't reflect its fundamentals, like Salesforce forward PE and price to free cash flow ratios dropping to around 18, that's when a true investment opportunity appears. But this time, there's a new elephant in the room: artificial intelligence. Many investors fear AI will erase Salesforce's competitive edge. Is that fear justified, or is it creating the perfect once in a decade chance to buy a market leadership? In this deep dive, we are going to break down the Salesforce business model and their powerful competitive advantage. Then we'll confront the AI risk head-on to see if their moat is truly under threat. Finally, we will put all the fundamentals and historically cheap valuation together to give you my long-term verdict. Stick around, you need to see the numbers before you decide what to do with CRM stock. At its core, Salesforce is the cloud king of customer relationship management, CRM. They started by putting sales and customer data management in the cloud, pioneering the software as a service or SaaS model. But their business is much bigger now. They offer a unified platform, the Customer 360, that includes sales, service, marketing, commerce, and analytics. They are essentially the mission control center for how a business interacts with every single customer. So, what gives Salesforce its competitive advantage? It all comes down to their massive switching costs. Once a company integrates Salesforce, which takes years and millions of dollars, it becomes the central nervous system for their entire organization. Ripping that out is a nightmare. It means retraining thousands of employees, risking data migration errors, and disrupting mission-critical operations. That risk alone keeps customers locked in. Second is the network effect from their massive developer ecosystem. Thousands of third-party applications plug directly into the Salesforce platform, creating a customized experience for every client. This ecosystem is a powerful barrier to entry for any competitor. This tight integration and high switching costs have allowed Salesforce to consistently generate that incredible free cash flow growth without a doubt. Salesforce fundamentals are getting better and better as the company grows. Right now, let's analyze our money journey checklists and focus on the attributes that you should look into a company. First, revenue growth. Salesforce has been growing revenues around almost 16% per year, which is a really good growth. In terms of market potential, we want to invest in a company that has good future prospects, and Salesforce is expected to grow earnings per share around 12.5%, which is really good growth, double digits. So that's a check mark for us. In terms of their revenues, I think they are high quality revenues. Their model is subscription, that is recurring revenue. So this is a high score for Salesforce. And you should pay a premium for that, even though you could argue that this could be under threat from AI. But for now, we know that their subscription and recurring revenues are high quality, and very sticky. If you look to their revenue graph, they've been growing every single year very steady, which is very good news, and you have to pay a premium for that. Product and process development, it's a yes, and the research and development, they are trying to get new products, improve their own product, their CRM base. They are trying to get into AI with agentic AI. We see Marc Benioff always talking about that, and that Salesforce has the future, or is agentic AI is the future on AI. So they are investing for their future, and that's good news for Salesforce shareholders. In terms of margins, high margin business. Gross margins of almost 75%, which is very high, and profit margins average almost 24%, but they have been increasing their margin. Right now, last year's free cash flow margin was 32.8%, growing every single year, and they are maybe getting steadily right now, but they are scaling their business. It's natural though, so they are achieving higher margins. So what should be the margins in the future? If they could sustain their moat, their competitive advantage, it will be free cash flow margins above 30%. But we don't know the future, but what we know, it is a high margin business. So they've been maintaining their profit margin. Actually, they are increasing their margins. If you look at that, for example, gross margins from 74 to 77%, free cash flow margin from under 20% to above 30%. So this is good attributes that we like to see in a company. In terms of competition, they basically are the leaders. They have their moat. So if you want to a CRM program or a platform, you go to Salesforce. They are the leader, the best in town. So they have better margins. They have pricing power because of their moat, high switching costs. So they could increase their prices. If the clients need their product, they will pay it. In terms of that, their balance sheet is incredible. They have $15.3 billion in cash and short-term investment, long-term debt of only $8 billion. So they are cash positives on their debt. They could pay all their debt with their cash on hand. So very good news. In terms of rates of return, it's something I don't like, or at least I expected more from Salesforce. So the money they invest, they only have the return of 9%. We prefer to have companies above 10-15%. And for a company with high margins, high growth like Salesforce, I'm expecting more. So that's something I don't like on Salesforce, especially. In terms of management and culture, they are good. They are very competent. Something I don't like, it's their stock-based compensation. Right now it's getting under control. For example, we see it here at green, it was a big part of their free cash flow. Right now is getting under control, and it's going down actually in the last few years. But if they don't continue to increase their free cash flow, they are still a very big percentage. So I would like to see the relation between stock-based compensation and free cash flow to get lower, but for that we need growth. But it's still under control. Management is returning capital to the shareholder, buying back around 1.5% of the shares outstanding, and I hope, if they really believe Salesforce as a future, manager have to buy back these shares. So it will be a sign of confidence from the management team, but we will see in the future. They have competitive advantage, network effect and switching cost that we have talked. Their free cash flow per share has been growing around 31% per year, which is incredible. So we came with a quality score for this company of 74.4, which is very high. It is a great company. They are not getting the best use. They invest a lot. Sometimes they get no return, but overall the company is growing very rapid with a good pace, and their fundamentals are incredible. But this could change. That's the question. AI could erode this moat. In my personal opinion, bear in mind, I don't know the future. I do not know Salesforce from the inside and what the market will answer in the near future, but I believe it's going to be difficult. They have the best product, and AI could help them. They will improve and get better their platform with AI as well. So I do not believe Salesforce will get out of this business, and with that, this might look cheap, but for that we have to do our discounted cash flow analysis, of course. So first, some question: is it cheap? We'll see on our discounted cash flow, but it looks like. Is it a good business? Yes. What could I miss? It's the AI question. Could this disrupt their business? This CRM platform will not be needed anymore, so every company will have their software. That's a question that will be answered in the future. For now, we are just assuming. So to get the best returns, revenues and earnings growth, it's a check mark. Salesforce it looks like it will continue to grow at double digits. P expansion, definitely. A company like Salesforce, with this growth, with these margins, with this moat, should have a forward P around 25 or even 30. At least it is what we are seeing in the market. Buybacks and dividends, it's a yes. They are doing buybacks, so. But this is a good question, and it looks like it could be a really great investment. But let's look into valuation. So, US company, the risk medium to low. So there are no bankruptcy risks, just the risk from AI to their business model. So for my base case, I will assume a 12.5 discount rate. Yeah, there are some margins of safety there, of course. I will not come with a fair value or an intrinsic value that like other analysts do. I want to incorporate some margin of safety already in my calculations. So for my base case, I'm assuming a free cash flow margin of 32%. They are expecting to increase their margin, but I'll try to be conservative. In terms of growth rate, they are expecting to grow around 12% per year. I'll be conservative. My base case is 9%. In terms of P, a company like this growing at this pace with margin that I'm assuming, I assume they deserve a 21 P. It could be 20, 18. You could assume a higher P. It's up to you, but this is my standard for a company like Salesforce. So with this in mind, I came with an intrinsic value of around $222.9. Right now, the company is trading at their lowest price to free cash flow forward P. It's very close to my fair value. It's getting like at a point that I could start a position if I believe in Salesforce. Right now, I don't have the answer yet. I'm still looking into Salesforce. I really like the company, their business, but I don't know if their competitive advantage are sustainable in the future. But if you believe that, this could be a really great opportunity because they are trading at a fair value, and usually these companies doesn't trade at a much discount. To wrap up our analysis, let's revisit the core tension. Salesforce is a fundamentally great business. They have dominated the CRM market for years, built an incredibly sticky product with high switching costs, and that has generated spectacular free cash flow growth. That part is not up for debate. The stock is trading down because the market is terrified that AI will erode that competitive moat by lowering the cost and time to build alternative software. But it is the key. If you believe Salesforce can successfully integrate AI and their investment in data cloud and generative AI are looking promising, then the stock's current price to free cash flow of around 18 is a steal. It's priced as if their growth is ending, but their fundamentals suggest the story is far from over. This stock is a classic case of market sentiment versus fundamental reality. If the moat holds, this is a fantastic long-term opportunity. If the moat breaks, it's a value trap. Which side of the AI debate do you fall on? Will AI destroy Salesforce, or will it be their greatest growth engine? Let me know your thoughts in the comments. If this analysis helped you find your next great investment idea, please hit the like button and subscribe for more deep dives into undervalued stocks. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.